My special guest this week calls himself the original Gold Bug, and that's the name of his new book, Gold Bug by James Dines, and he joins me now. And James, in the intro in your book, you talk about something that was sort of a key turning point for you. In 2000, the ratio of gold to the Dow Industrials, it had been in a downtrend. That turned around. There was a penetration indicating a new bull market phase. I wonder if you might talk about that graph and how key that was in terms of your call urging your subscribers to get back into gold.
Sure. That was a great call. Everybody made a lot of money on that one. Basically, it's a graph that describes whether golds are weaker or stronger than the rest of the market. And it shows it in very long-term trends. This particular one showed that golds were a sale in 1980 and a buy again in 2000. So it was a 20-year turn. And the cause of it is that we were moving from the intangibles, such as the Internet, which we got out of, fortunately, in 2000, into the tangible arena. And since then, and we've been bullish all the way up and stayed that way, and we've been concentrating on investments in areas with wealth, what I call wealth in the ground, that cannot be printed and cannot be created by some kids in the garage. And I think that is the way to make money in the coming period. And it's been about 10 years so far. We could have another 10 or 20 more years of this.
Now, another thing that you are calling for in your book, and this is going to come as a great surprise to many listeners, and we'll get into this later on in the safety trade, but you expect a tragic crash in the U.S. dollar in bonds, which for many of our listeners, if you take a look at the money that has flown out of stocks and has gone into the bond market at record amounts, that would surprise a lot of people.
You can't just look at the buying side of the ledger. The truth is that China is dumping its bonds, and they're doing that because they already sense that the dollar is in very, very grave trouble. You know, a lot of people run around talking about bubbles. They see a bubble here and a bubble there because they missed the real estate bubble. And one of the 65 Dinesisms in the book talks about bubbles being invisible to those inside the bubble. The way to identify a real bubble is you don't see it. And you can look at, for example, the currency. Every nation in the world is printing all the money they want, and everybody views it as normal. And that is the classic bubble. When they get popped, you have very, very serious trouble. So when this thing finally does break, I mean, they're printing money now. It's out of control in this country, in America here. And at some point, people are going to have enough dollars. And when they do, they're going to go somewhere else. Well, where else can they go? For the moment, the flight to safety is to the U.S. dollar. But when they get tired of the dollar or fed up with it, the question is, where do they go? And my prediction is very clear. They're going to be going to the ultimate money, gold. And another one of the Dinesisms says that gold is the real money, and it is the center of the monetary universe. And instead of a price of gold, it's a question of how many pieces of paper an ounce of gold will command in each different country. And that depends on how much they print and create with credit. So in that regard, I would expect a massive flight out of the dollar at some point into gold. I think it's already happening with the Chinese. That's where the proceeds, their sales of U.S. government bonds, is going now. It's going into gold, and that's been causing this tremendous uptrend. We flashed our buy signal at $288. It's now at $1,100, and a 3,000% gain. And let me tell you, there are people who have done worse.
You know, you prefer gold shares rather than actual bullion because there's more leverage in the gold shares. In another statement that you made in your book, you're adamant against leaving gold anywhere near your home. A lot of people have disparaged safety deposit boxes or, let's say, vaults. But in the turmoil that you see coming, you don't want your neighbors knowing that you've got a stash of silver or gold in your house, which I agree with.
Well, first of all, I don't prefer stocks over gold necessarily. And I covered that in great detail on how to invest in gold and whether it should be in the real stuff or not. But the one thing I am adamant about is don't leave gold near your home or on your person. And don't carry money around with you, because safety is more important than money. And if you have gold and something bad happens, it's not going to help you. So safety is first. Now, I agree that there's a danger of leaving it in a safety deposit box. I covered this in my chapter on history of gold and how Roosevelt took it and why and what he said and what the press headlines were at the time. And the reason I did that is because it might well happen again, and I want my readers to understand what really happened. So I would say that the way to avoid that is put your gold in a safety deposit box in a different country, preferably more than one if you can afford it. And that's the way you handle that. But I don't see that it's necessarily crucial to avoid a safety deposit box in your own area. You could put some in there. You need to diversify. The truth is, when this bubble pops, nobody knows what's going to happen. It's going to be bad. And many Americans have guns, so it depends on whether we have a hyperinflation or not. And for the moment, I think that it's important to own some gold, but also gold stocks because they do have more leverage. But you have to remember this. The mass psychology of people who own gold itself is different from those who own gold mining shares, and so they don't always move together. Now, right now, recently, gold bullion has been outperforming the gold mining shares, and these tend to run in trends also, and they reverse. Sometimes it's the reverse. So my third book, Mass Psychology, goes into how stocks express the mass psychology of the type of person who buys it. Something's bought by bankers, for example, generally will be very different than penny stocks bought by people who are speculators. They have different cycles. So I would have a mix of them and also a mix of locations. The nice thing about having gold mining shares is that they can't be seized. If you get to another country, those shares are still yours. You still own the underlying stock, the underlying mine.
I want to talk about a key point that you made in the first edition of your book, The Invisible Crash, in terms of the true cause of what happened leading up to 1929, because it's been totally misinterpreted by nearly everybody. You hear talk about speculation. You raise a little-known issue that very few people, I would say, are familiar with, and that's the Genoa Conference on April 10th of 1922.
Yes.
Let's talk about that conference and how it changed events leading up to the crash.
The reason our present leaders cannot solve what's going on is because they learned a mistaken version of what happened in the 1930s. And this is one of the key points of the book. You cannot understand what is going on in the world based on the paradigms of what they think was learned in the 1930s. Fedhead Bernanke boasts about being a scholar of the 1930s, but the 30s were the result of something that happened earlier. You have to go to the cause of things, not the result. You can't treat symptoms rather than cause. You can't declare that wet sidewalks cause rain. You need to understand what happened before. And I have never seen anybody, I don't know of anybody else, who talks about the Genoa Conference of 1922. And in it, something extraordinary happened. Well, first of all, I go through the history of, and I think the most important part of the book is the chapter on the history of gold, and why people hate it, why governments are so against it. And let me backstep a little bit, if you will. In the 1800s, there were a number of financial crises. Every single one of them was falsely blamed on gold. For example, during the Civil War, Abraham Lincoln seized the gold owned by the banks that had been backing the currencies. He seized the gold to pay for the war. And after he did that, the currencies crashed, and they blamed it on gold. That's typical of what happened in the 1800s. So in the early part of the century, of the 20th century, in the 1900s, after World War I, the Versailles Conference pinned the blame on Germany and pinned prohibitively large sanctions on them that had to be paid in gold. They made them pay for the war, basically. Well, Germany tried that for a while, but by 1920 and 23, they had a horrific hyperinflation, and they were bankrupt. So the Allies, who had been counting on German gold, were stuck with the question of how do they pay for that World War I. And they came across this ingenious idea in 1922 in Genoa, where they took the gold standard, which is where all the English pounds were backed by gold in the vaults in London, and they said, look, the pound is backed by gold, and we have gold. Why don't we count both of them? We can change it from a gold standard to a gold exchange standard.